US rallies have been halted and turned around to only fall back down, showing that the bears are in control. We're understanding how far these pullbacks, what the impacts are from the presidential cycle into the market, and also how that all flows over to the Australian markets. Gary Glover from Novus Capital is guiding us through. Good morning, Gary. How are you?
I'm great, Chris. How you going, right?
Well, I'm pretty excited about this week's report. It's a bit of a different one because you've done a lot of research. You've pulled out the archives. You've looked at some historical performances, and you've got this going back a very long time. And some averages that you were just telling me before we recorded were jaw-dropping how much the market rallies out of some of these movements. So I'm keen to hear about those. Before we jump into all of this, it's probably worth checking in on the portfolio because you've said for the last couple of weeks you've added some shorts. How's that worked for the portfolio?
It's working all right there. I wish I'd sort of got to really 10% of the SNAS. I've only really sort of got 6 and 6 there. So I've got about 12% of the portfolio on the short side there. I'd love to sort of get that towards 15, 20. But I'll get a few little bounces in there. Just so far, the thing about bear markets is that the rallies are sort of short and sharp. So you really got to, when everyone else is getting excited, thinking that we're off to the moon, that's what we'll go to try and sort of add in there. So, I think we're sort of starting to see some reasonable sort of breaks to the downside now. Starting to see quite a lot more distribution days, so sort of down days on increasing volume. So those are negative signs as well. So we sort of hit a nice low there last night, had a bit of a bounce up from a bit of an interesting level. So maybe we can rally for a couple of days here, but I still expect any bear market bounces just to be sort of short and sharp and be over pretty quickly.
This is a pretty well-informed position that you're coming from here with the bear market, the tendencies in the bear market, the rallies, the ebbs and flows. So you've got sort of setting the scene for where we are today before we get into the historical data. You've got the NASDAQ chart on here. We can see that it's really come down heavily. The rally didn't get anywhere near up to the highs. So what position does that put us in now with the NASDAQ?
Yeah, so come back down near the lows there. I'm saying the heavier volume days on these sort of down days here. So not bad volume there last night. So maybe we can rally for a couple of days there. But I just think any sort of rally is going to be short-lived there. I still think the pressure's on the downside here. I just can't see anything but deeper levels. We're approaching the, for me, April through to that sort of June, July window is really that's where most of the damage gets done in these sort of these midterm years and our cycles. So just just basic normal seasonal patterns. So the whole sell and May and go away as well. But these sort of midterm years, just a lot of cycles all sort of culminating that we're in the danger period right now for markets, and the price action starting to confirm that. We've tipped over, had a bit of a first lower high here, bit of a counter move, and then we're back down to the low pretty quickly. Good volume as well. So I know we're going to see a few little bounces here and there, but it all points to sort of lower levels to me, and just whether we do the measured move in the first leg or we do something a bit deeper. I still favour something deeper here. I just think the conditions are sort of really adding up for increased volatility here. So I think we'll see a low. Just whether we see a bit of a low in July or October there. October is kind of a midterm year sort of strong phenomenon, but I still think we might sort of see it earlier this year and maybe a higher low or something in October, but we'll see how it plays out over the next couple of months. Charts are sort of still pretty negative from my idea. The bears are definitely in control.
Well, the bears control on the NASDAQ and the S&P, that's a similar sort of thing where you're showing on the chart here in that red box, that's a lower high. The same sort of concerns in June, July timeframe targets for the S&P 500?
Yeah, similar as well. So like arrow sort of a measured move there from the first leg down. So it doesn't really give us a massive decline there. I think it'll go a bit deeper than that. So, I just think conditions look pretty ripe here for a larger pullback there. And we'll look at some of these midterm charts, and that'll give you some good reasons as to why I think we'll see something a bit deeper.
Well, that's something we'll just flow into. We'll just check in on the Aussie market in a second,
Yeah.
because credit where credit's due. This is something you mapped out months ago, saying that you believe the Australian market would outperform. We have the higher value, the less growth. We could possibly hit marginal new highs and go for like a megaphone formation, getting quite volatile, higher lows, lower lows. That seems to be panning out. Is that sort of playbook still showing on the Aussie?
Yeah, it's amazing, isn't it? Just sort of, you know, history sort of, sometimes, you can do all the homework and you sort of, the history is telling us that this could, we're going to outperform. We're potentially going to, rally to a new high, which, you kind of like, oh, really? But when you actually see it, it's all it's done is just follow the path that's been tread before. So if we talk about that 2002 period there, how as the US market sort of made lower highs and went pretty deep, our market actually expanded and made these marginal new highs, just kept making, marginal new high, marginal new low, marginal new high, marginal new low. So really did this sort of broadening type of pattern here. So yeah, it's quite amazing. We're actually sort of seeing it develop here. So I do think we've just gone marginally above the first lower high, so didn't take out the high. But yeah, that's often all we see is just little marginal new highs there. So just taking out that previous January high is probably enough here. So yeah, interesting here. So yeah, I think oftentimes these sort of marginal new highs there, they can be followed by marginal new lows. So that gives us a target sort of slightly below the last low. And the thing about these broadening patterns is they can be pretty quick. They can get down to those levels pretty quickly here. So yeah, it's a bit of a bearish sign. Yeah. So, but not monster moves compared to the US, but still a reasonable decline.
Definitely enough trading opportunity within those movements. And the chart that you've got here on the screen, from that mid high, so there's the 76.20 in January, that came down within 4 weeks to its low. So it's a lot of opportunity in those movements.
Yeah, so we only dropped about 11.4% the last leg here. So maybe this will be a bit larger. Maybe this will be like a 13 or 14% decline or something like that. So it's not monstrous, but yeah, just more typical of sort of what happens when we see growth get crunched here. So yeah, our market holds up better, but we still sort of have these movements, I guess, as well.
Well, now's probably a good time to come over to the history lesson of these midterms. As we're working through this chart, you've got the 1958 to 1988 period. Can you just tell us briefly what the midterms are and then explain what this chart's showing us?
Yeah, I've sort of kind of been working backwards here. I really probably should have laid all the data out first, and then highlight the charts here. But we
can jump through to that table if you want to.
Yeah, well, no, we can. It's pretty obvious if we look at the charts here. Well, so those two red lines there, Chris, what they are is that they are June to October of the midterm year. So every 4 years. So this is sort of it's often referred to as the year of the bottom picker, the midterm year. There's a lot of and if you look at our 4-year presidential cycle, this has sort of got our worst 6 months sort of falls into that October window, and our best 6 months often follows the October of the midterm year. Some pretty phenomenal numbers there. I mean, one stat here, which is just amazing there on the Dow Jones, is that since 1910 to 2010 was sort of I did this research about 10 years ago, was that from the midterm year low, which is obviously the October low, to the following year, so the high in the pre-election year, so basically a high within the 14 months. The average return on the Dow Jones for that 100 years was 49%. So that's a cracking return, just from being invested in the market for less than 14 months every 4 years. So that's it's referred to as the best 6 months statistically off the low, the best 13 months off the low, and the best return if you're measuring from the low of this year into the high of the following year as well. So it really just sort of highlights it. Just this midterm year it's which is like it's just like an anchor which sort of pulls the market down into these sort of lows. And then we can just sort of see here all the returns that come out of these markets. So this is sort of often referred to as the year of the bottom picker. We just get some really massive moves out of these lows here. So that's why you want to sort of see something a bit deeper here, because oftentimes the recoveries are pretty massive. So
49% average over 100 years is
that's big. That's way beyond sort of average and norms stuff there. It's it's obviously a bit like the what do you call it? The sell in May. It's obviously like if you're invested from May to October versus October to May, those 2 different 6 months there. I think if you've invested in one of those periods, you get about 101% of all gains, whereas the other period you actually lose money for spending the 6 months. So there are some cycles within the market which are pretty interesting and some big returns. It doesn't work out every year. We can show it in the last couple of years it hasn't been as strong, but historically this is the one to keep an eye on here. If you get a deep pullback into the midterm year, into that sort of mid to late year, well, this is the one to be. So you need to have a little bit of powder dry, and need to be able to weather that sort of 6 months prior to the October, which is we're right on that.
Right now,
we've stepped into that doorstep already, so we're 1 month in. So it's this is a risky period here. So it's all in front of us there. And if you look at some of those, I've highlighted 82 to 2010, looked at 94 through to 2022 as well. So the only thing
we're just on screen, we'll hold that for a second. The 82 to 2010, you highlighted sort of some 3 large, long, and 1 short, sharp rally into it. And so it's.
It goes back to 58 to 88. If you go back to 1910 as well, if you've got historical data there, you can you'll see this just really, really strong sort of flow there. But the thing about this chart is that most interesting for me is the last 2 years, the last 2 cycles, they haven't been that fantastic. They've been okay, but in terms of looking at previous periods, not as phenomenal as most of the other midterm years. So the last 2 have probably been average midterm year lows. If that. I think actually last year the October was actually the high, wasn't actually a low. Did swing back down and then go back up again, but just those haven't been as strong here. And the one thing I've learned about cycles over the years is that the strongest cycles there, if they get out of whack for 1 year, they tend to stay out of whack for a following year, and then they go back to normality. So if Sorby had 2 less than average years here, so kind of maybe out of whack, the next one we should be going back into normality is sort of what the theory. I think Peter Iliadis, who I consider one of the best cycle guys, that was sort of, he always spoke about that. And from what I've seen in the past here, with looking at 60-year and 20-year and decade cycles, I tend to agree. I think it's one of those things that if it doesn't work 1 year, it won't work the following year, and then it will sort of work again. So so it's all adding up here for a bit of a deep pullback here into this this sort of June, October window, and then we could see some exciting moves out the other side. Some of the stats are pretty amazing, really, from the midterm years as well.
That 49% is just jaw dropping, but it probably helps to understand this 4-year cycle. So it's for those who've listened for a long time. We've touched on this a couple of years ago. Can you just walk us through this chart on screen, the 4-year election cycle and how that works, and then obviously the midterm that you've just highlighted?
Yeah, so everyone sort of looks at obviously the election year cycle as being one of the strongest one, but the midterm is for me is more powerful there, because this this kind of smooths out some of the performance there and looks at maybe sort of closing periods and stuff there. But the midterm year has this really deep pullback there. It doesn't sort of show it on there so much, but the rally coming out of the midterm years low is pretty strong. That's definitely one of the strongest rallies in the 4-year cycle there. So this is kind of an important period. for markets there. If you can kind of get the timing right here, that's the sort of cycle there. But if you look sort of under the hood, take a little deeper look at the midterm year. And I looked at it back in 2010. I did a research piece there, or might have actually been a couple of years later there. But just looking back at 2010, or looking back sort of 30 years there, what was pretty interesting was the drop intra-year. So over that sort of 2010 to 82, the average drop on the Dow was around 16.6%. So pretty deep there. I mean, there was like a couple of 22s and a 32% drop in those periods there. But look at the rallies as well. So once we sort of marked a low intra-year, the rallies that actually came out of those lows and finished at the highs were just super strong. And so we're only looking at a couple of months here. So if you can nail this sort of low here, the rally by the end of the year could be quite phenomenal. So the Christmas rally this year could be really on. We hadn't had a really good Christmas rally for a long time. So that cycle's sort of been off skew for a couple of years. But this is the year where we really get the really strong rally towards the end of the year. So yeah, anywhere sort of July, August, sort of October, the other sort of lows here. So I got a lot of timing around July, but October is a magnet for years ending in 2. So if we go back and look at every 20 years, I think I showed a chart previously. I think it was 02, 82, 62, 42. They were all some pretty deep lows in October. So something to be mindful of there. But yeah, some of the stats this year are just amazing. It's like you've got your worst 6 months into that October midterm year. You got your best 6 months, you got your best 13 months. You got your best low to high performance sort of from the midterm year to the pre-election year. It's just a lot of this is a really important year, typically, from a statistical point of view, from a historical measurement. So nothing's guaranteed, of course. Always, they can always skew, but history has told us this is the year. You get this year right, you can make some pretty serious gains this year. So we're just looking for some potentially like a deep, to get that sort of return there, Chris, that sort of bounce. Probably need to see something a bit deeper on the downside. So if we're going to get anywhere near 49% return off the lows, we probably need to see a deep low. So even to get half of that, even to get like a 25% return, we'd need to see something deep here. So just history has sort of has indicated that this 4-year cycle just tends to pull markets down in there a lot of the time. Not all the time. The last couple haven't been predominant, but I think there's a high chance of it actually happening again. Just looking at what's happening here at the moment.
Well, that's got something. We're looking for another hit in the market, but if we do, then we can kind of be looking forward to the potential for a really solid rally, like you're saying, return to this normality that has held kind of a century.
Yeah, and we're already seeing some really sharp falls and some sharp rallies already. So those conditions are already sort of here. They just might, the thing about that broadening pattern on the XJO, the 2000-2002 period, was that broadening pattern just got bigger and bigger. So the swings got, we think we got swings here now. Those swings got larger and larger and larger. So might be happening on the US market, might be happening on the market as well. So the swings could get larger here. Volatility could get even greater here. So I just had a look at the all ordinaries chart in there, because sometimes I looked at the old index because it can look a bit different. In this case, it is slightly different in that we don't have the August high. We actually had a January high, so that actually ended up making a false break. Came down to a new low, gone to basically make another lower high up here. And so again, we're sort of starting to broaden here as well, but there's no reason why this can't come back down to the low there. And that's in terms of taking that previous sort of swing low out. A really good low would be the old 2007 high, which is sort of highlighted there, and that would be a nice target zone there to look out for. So that's one chart I'll be looking at really closely. If I see the index down there, that's probably that could be a really good entry zone for for our market there. So I don't expect us to get hit as hard as the US. I think we'll hold up pretty well. We have sort of so far. I still think we can probably go to a margin new low if the US does have that pretty decent sell-off.
Well, that could coincide with the anchor that you're talking about with the US markets in that cycle that pulls it down. You could be coming back to that 07 low around the same time. Would that timing kind of fit in with the windows?
Yeah, I mean, look, you've got interest rates about to move high here. Obviously, they started in the States here, so you've got central banks around the world already starting to move rates up here. So we're going to see higher rates there. At some point, we're going to see higher taxes here. That's coming as well. Just you can't give out free money like we've done without having to. At some point, we're going to start paying back. And central banks now sort of starting to take money out of the system there. Yeah, you get a lot of supply issues. You've definitely got some geopolitical issues as well. So there's a lot of things happening in the world which could cause a few concerns for the market here. So I think there's actually some good reasons as to why the market can actually get a bit of a scare and pull back here. So just takes one or two of those things to sort of deteriorate here. And so I'd just be cautious here. The next 3 months for me is that's the danger period in markets here. So I think I've been talking about this for a little while now. So I'm not haven't changed my tune, or just if anything, all the evidence is actually just growing to support that view. So but I guess the beauty is that if we do get a bit of a shock here, history is telling us here that this is the year to buy the shock. Do you know what I mean? So if you can nail the low here this year, the returns that follow can be say it's July or October, and in the world's the markets are all correcting and they're all getting pretty ugly. That's when everyone will get pretty scared. Everyone will be afraid to step in, but history is telling us that is the moment to step in. So interesting.
Well, it helps to be forewarned is forearmed. So in that, when we see blood on the streets, these anchors coming in, the market's getting plowed down to these lows, the 2007 high. We know to look for that as sort of a buying entry time into the markets.
Yeah. Look, I don't think we'll see a 49% return at the Dow. I really don't. But there's no reason why we can't get a 25-30% return there. And we saw in that 2002 period, our market had that sort of 11% drop and then a 16% rally. I think it was like a 13-14% drop, and like an 18% rally. It had like a 21% drop and then something 25% rally and then a 23% drop. So something like that. It was just got bigger and bigger. So can sort of happen.
And the volatility just keeps growing, even though we think it's really volatile. It grows.
Yeah. That's the one thing that's obvious to me is these markets. We think we've seen volatility so far. I think we're only halfway there. We've only just probably this volatility is just getting warmed up. I think so. I think we're going to see some super volatile periods here, much greater than we've seen already.
Right. Well, that's something I'm not sure whether we look forward to it, but we definitely look forward to your insights to guide us through it. That's for sure.
Yeah. Thanks, Chris.
Thanks, Gary. Talk soon.